that, and so as I was saying before the recording stopped, all the stuff that you have to go through to get back to the country, I had to retest within 24 hours, and I got back fine. But once I got here, I got COVID. So don't stay in the United States if you want, if you want to keep away from COVID, I guess is the message. But I'm officially today negative. So hopefully, I'll be a little more with it. I'm gonna go through a few things, and a lot of them are going to be Napa centric. I'm going to go through some industry things and just a few economic things, just to kind of catch up with that. Let me see if I can make my slides work. Oh, there we go. Okay, there we go. So economic trends. I'm just going to be real short on the economic side. There's just a lot of uncertainty right now in markets, whether it's supply chain or effects of the war. Some of the more recent heartbreaking things that we've dealt with, that actually does impact markets as well. But all things considered, I'm actually feeling pretty good about where we are. If you look at especially like hotel occupancy, as of now, we're back up to where we were in 2019 in the Napa Valley in terms of occupancy rates anyway. I think we're a little ahead actually in average room nights, if I'm not mistaken. But here's broad U.S. retail sales in April, and you can see if you really want to be successful, then be a miscellaneous store and retailer. That's that's where all the action is. But for us, we're down here in the food beverage stores, and it's probably not surprising, when you think about on the reopening of all of the restaurants in the United States. We're getting close to being where we were in 2019, but we're not back. And for all you guys that are trying to hire people, you understand the problem. Trying to find the right kind of staffing has just been really, really hard. That's driving some of the inflationary pressures that we see. So over here on the right side of the screen, you can see a chart on inflation. Goes back to 2010. You can see the big dip in 2020 from closing everything at that one point. Retail sales, if you look at just retail sales, it's up 29%. You're going, wow, that's great, But actual normal sales, nominal sales, which takes out the impact of inflation, is only up 9%. If you look at the wine industry right now, the wine industry, you're going to find different analysts that give you different numbers, by the way. Because all of this channel shifting between off-premise and on-premise has been made it very difficult to really analyze what's going on. I'm going to say right now for the wine industry as a whole, we're somewhere around, I'm going to say flat to up. Let's just go say -1% to +2%, something like that, in terms of overall growth. And I'll show you some more slides in a second. But the premium side in Napa Valley, it's kicking ass, honestly. It's that's the part that's doing really well. But what you want to be is you want to grow over 9%. That's just 9% growth now is just holding your own. So you have to think about it in those terms. So here's the inflation. If you just look at core, which strips out things like that are really volatile, like food items and in theory gasoline. But gasoline costs start to go into things for services anyway, like airline fuel, and which affects tickets. So it's not particularly pure. But this is what you see for services right now. Commodities over here, you can see we've kind of rolled over, and you guys are probably aware we've had supply chain problems. I just did my kitchen. I started my kitchen March of 2021, and I finally got my stove in April of 2022. Those are the supply chains. It's stuck on a boat somewhere. I don't know. It's just a simple stove, but we've all been through this now. Commodity price, whether it's lumber or whatever, highly inflationary commodity prices, and food prices are still obviously really inflated. That backs up into restaurants and a lot of the things we do. services, we're a service economy and it's lagged. So here's services right now, and you can see that service is started to pick up. So the lagging that's been happening with, you know, the hiring and getting restaurants and everything back up to speed on the service side is starting to take hold now. So that's good. So what we're seeing is, you know, the kind of issues that were impacting supply chain are starting to be sorted out, and that's dropping the commodity side, and then the service side is coming up. And we're a service economy. Historically, we haven't, maybe the last 2 years, we've been more of the durable goods economy, but, you know, because we've been just buying stuff nonstop, but we're a service economy. And so the impact of higher services actually have a 5-time greater impact on gross domestic product over the commodity side. So when you see these small gains in services, it actually has a major gain on GDP as a whole. This is another reason I like what I see ahead, especially for the high end of the wine business. So savings rates went way up in the pandemic because nobody had any place to go. They didn't have any, you know, if you had discretionary income, there's nowhere to spend it. You couldn't go to a theater, you couldn't go to a basketball game, football game, college game, couldn't go to a concert, couldn't do anything. I mean, for a while, you guys remember, you couldn't go to a beach. You know, there was a lot of beaches that were closed. And so, you know, the money just stacked up in people's account. Now, the interesting thing about GDP is money that just goes into a savings account doesn't impact GDP. It doesn't do anything. It's where money is spent is actually on the lower side of the wage spectrum. People that, you know, live paycheck to paycheck, they're spending everything. So when you get those fiscal stimulus, like from the federal government as an example, people get, you know, checks. That actually does do a lot more than the savings, but the savings are dry powder. They actually are, you know, money to be spent. It's money that is, you know, in people's pockets, and in many cases, it's burning a hole. If you look at the right side of this, you can see the top 1%. Their average wage is $820,000 a year, and the top 80%, 80 to 90% is 173%. So that's the core part of people that come to Napa's in both of those bands. It's not down at the bottom. And so when you look at this, I don't know, can you guys see my little screen pointer? Oh, good. So when you look at this, this is distribution of liquid savings by income level. This is the total amount of savings. So you got a trillion here in the top 1%, 803 in the 80 to 99%. And over here, you can see where it's distributed by, you know, by income. It's a little bit different, not too much. And, you know, it's all to those top. So these are our customers. These are the people that come to Napa Valley. These people that stay in the hotel. These people that come to your business. And they have a lot of money, and it's burning a hole in their pocket. And as I kind of was talking earlier, you know, it's still not easy to go places. So one of the things we're seeing, particularly I think in the Napa Valley, is a little bit of a boomerang. And so I'm not ready to say that this is going to be the way things are from here on out, because we have some other things to talk about, and we'll get to those in a second. There are some, let's call them difficult news. We'll call it that. So this is something that's talked about a lot in the investment community. It's the 2s minus 10s is what they call it. And that's the 10-year Treasury bill from the 2-year Treasury bill. And people talk about a yield curve. Yield curve is it's short versus long term. And normally, because you have higher risk in a long term, this is a long term over here. You would expect to see longer term have higher rates than short term, and that's kind of normally, right? So you know, prime rate's going to be, let's say, 3%, and maybe a 10-year Treasury might be 4.5%, 5%, something like that. That's normal. When a yield curve is flat, that's abnormal, because now you're discounting the risk over here. My screen's backwards, and when it tips, you know, the opposite way. And the long term is shorter than the high yield. The long term is pardon me, the long term is lower than the short term. That's called an inverted yield curve. And so when you look at this measure, it's a measure of 2s minus 10-year Treasury bills. And so it's kind of measuring that what's happening with that movement in between the long and short term. And this has been a really great measure of, it's predicted every single recession that we've had in the last 50 years. It's early indicator. And so if you look at this one here, this is the COVID period in this measure. And so these are basis points. So you can see if 0 would mean it's totally flat. We're just down to 0. So when we get down to here in March, now we're dealing with the war, the Fed saying they're going to increase interest rates. We're worried about inflation. The yield curve, when you hit that point where it's 0, it worries the investment community. And true to form, we've seen the stock market just drop like a rock. And then let me go to the next one. If you just take this little part of it here, more recent, now you're seeing this end right here. So since the first part of April, we've started to kind of hit bottom and move up a little bit even. And that's given a little bit of hope, I think, to a lot of people that maybe we're through the bottom of the market cycle on the stock market in particular. And stock market is probably, you guys all know, it's a future indicator that market's always looking forward. But this is another. So this gives me hope that we might not be going into a recession. We actually might be going into another upturn in the stock market, which is all good for us. Those are all the people with money again in the savings that all end up in Yountville. So here's some more good news. When I did analysis this last year, we do surveys. I hope some of you guys are doing those surveys if you're with wineries. This is a tale of 2 years. If you look at this this little gray line here, this is where things were in 2020. And so in 2020, almost 40% of wineries said that it was one of the most difficult and challenging years that they ever had. I mean, ever. That's a long time. And then when you get to 2021, it flipped on its head. It's the trend line goes back up here. And so, you got 35 and 27%. What is that? To something like 62%, something like that. 75 as well. I think that's right. 62%. It's one of their better years, and 27 said it was the best year in their history, and that's a really long time. And what a turnaround. And so now the question is that sustainable? Can you have your best year in history every year? Probably not. Trees don't grow to the sky. Popular opinion might say otherwise at times, but they don't. When you look at where Napa stacks up against the other regions, 82% were on the good side of that equation for this last year, and a very small part were on the other side. So it's a very good year. And actually, I got that pretty little arrow thing on the right side. That's flipped around. So ignore that. Ignore that thing. I'll have to fix this slide. I did that last night too. So maybe my COVID isn't quite gone yet. I still have a brain fog, but I just flipped that around. This says that Napa County had one of the better of all the AVAs. Dollars growth, just DTC. Most of Napa's DTC, direct to consumer, right? And when you look at what's happening with dollar shipments, case goods and dollars, you see this a lot, by the way, in a lot of places because of inflation, in part, but also because of crop sizes. In Napa and in many places, we're not keeping up on the volume side of things. The volumes are dropping, but dollars are going up. And so Napa, in terms of dollars, has seen the greatest growth. Now, this is coming off a year where in 2020, there was a lot of discounting that was happening, especially in fine wine. So it's probably not going to continue. Those trees aren't going to grow to the sky. And they probably shouldn't, because there's only a limited amount of the best wine in the world. And, you'd kind of like to expand that opportunity for other people to to enjoy that besides the upper 1%. And so you have to, maneuver and find where that place is. But 18% growth on dollar. I mean, you can't grow 20% each year. That just won't work. But that's pretty nice. We had positive growth in cases and positive growth in dollars. That was a good year. And from what I can see, I don't think we're going to be in that 18 to 20% range. And I have another slide. We'll talk about that in a second. I'll just wait in this next slide. I'll show you where we're headed probably. So this is using the SAVO ship compliant data, but or SOVOS, pardon me, ship compliant data. So dollars on the left, volume on the right. You still kind of see the same thing. It's dollars are up, year over year in the direct consumer side, and growth again is skewed toward dollars, not cases. It's the same thing for steak, by the way. It's the same thing for mayonnaise. That's what inflation does. So that's a component of this. And as I said before, you got to be at about 9% to just be keeping up with the rest of the market. And we're at 1% growth on the volume side. So that's not there. On the dollar side, for the industry DTC, we're there. All right, neutral news. This is kind of the story of what we've been through. So here, excuse me, here on the left side, this is pre-COVID. And so let me say this. So the greenish color is the value change year over year, and the blue color is the volume change. So when you see it, like in this case here, we have a volume that is lower than value. That means that there is price increase at that point, right? There's price increase. When you see it down here, it's the opposite. You have a decline in volume. So that means they're discounting. So here in this place, pre-COVID, remember where we were going into COVID, and people don't. But the industry was struggling. I mean, I wrote a state of the industry report that it wasn't very ebullient. Is that a word? Ebullient? I don't know but you know what I mean. Happy. It wasn't very happy, and I got a lot of unhappy people because I said it was unhappy. We're an industry that really likes happy, but I do think I was right. But who knows? Because we had COVID, and this is just, by the way, the store side of it, the grocery store side of it, right? Not the restaurant side. So you go to the restricted business condition where everything, went through grocery stores because we had to close the tasting rooms and restaurants and stuff for a while. And you can see what happened with everything getting shoved into grocery stores. We had this big time where we had price increases. So price increase was above volume, and it's the opposite now. So now we're over here with reopening, and I've shown you some of those other slides, and we're back to the other thing where we have worse volume changes. So volume changes are lower and the value changes are higher. So now we're starting to, as an industry for grocery, be more in the discount. It's not the same for what we're doing in the high end of the industry or the direct consumer side. But for the luxury side, it is. So this is kind of the story of what we're being just on the grocery side. Restaurants, they're coming back. I can't say we're there yet. Again, this is seated diner. So think about more as volume. I'm sure all you guys go to restaurants and that prices are up. Prices are up a lot, and it's hard to find staffing, and so wages are up a lot. And as long as we have wages up and we have laws that are set to increase minimum wage on top of it, those will be reflected back in prices. So we're going to continue to see prices going up. So sometimes when you see, hey, look at the growth we've had in revenue, it doesn't equate to profit because you have to take out the costs. And some of this is, again, we're just pushing the revenue higher because our costs are higher as well. But the good news is we have a consumer that is willing to pay for some of that. So that's the good news. I would say we're almost there. We're almost back to where we were in 2019 in the restaurant side. The fine wine side is done very well. The industry as a whole has not done well. This was back in December, by the way. We're like 10% in terms of just number of accounts in restaurant, 10% below. I think we're about even now. So I was alluding to this slide a little bit earlier. We had an 18% growth on one of the slides. This is slides, a database that I have of financial statements in the fine wine segment. So these are audited and reviewed financial statements. So it's good data. You can see the growth that we had going back to 2000. Very high growth rates, and then we had the tech bubble and we drop, and then we get back up to the very high growth rates. It's easy to get back up because you're coming off a down year, so it's easy to get back up. Now, can you hold it? And obviously you can't. But you see the trend that's been happening for quite some time is the growth rate's been slowing and slowing and slowing and slowing. And then, we hit COVID, we're down 0.6%. We go up to 21% growth. I mean, nobody saw that coming. Of course, honestly, I thought pandemics only happened in movies. So it shows you how dumb I am. But 21% growth, coming out of it, that's amazing growth. I don't think that's sustainable. If you look at what's happened, in prior years, here's, look at the dips, 5.2 minus 3.8. That's the Great Recession, minus 0.6. And again, these are wineries in Napa. Think about it that way. These are fine wine producers. You have a rebound, and then you have something that comes back toward this long-term trend. I don't know that we're really looking at let's call this 5% growth. That's kind of where we were coming into it, but I would suspect it's probably somewhere close to 10% for the fine wine industry. So it's better than the trend, but the question is, can we sustain it? Let me check on time really quick. Okay. Sales growth in Napa. This is another one of those slides. You can see that change in sales, 17%. This is just Napa alone, 17%, volume 15%. It's part of that trend we're talking about. The fine wine, we're seeing growth in value more than volume. So some of the difficult news. This is an industry slide, and this is comparing the spirits industry with the wine industry as a whole, right? Not just, this isn't just the fine wine segment. It's important to understand that. And this is a volume chart. So you can see how things were going. Spirits were doing better than wine, during the COVID period. And right here in February of 2021, we reopened, and we started to have restaurants reopen. Excuse me. And I never saw this coming. I thought that the restaurants were going to start to, buy wine, fill up their cellars that had been depleted. And the answer is, on the whole, they didn't. On the whole, what happened is wine started dropping, went the opposite direction as a whole. And spirits have taken away market share from wine. Now, this is a major industry problem. So when we look at where we are today in the fine wine side, where we live, Napa Valley, things are good. But when you look at the industry, that's a long-term change that we're going to struggle with, because there's effectively what I call on-ramps. There's a couple of on-ramps. Tasting rooms are one on-ramp. You get new consumers into the tasting room, try the wines, they buy the wine, they become a fan. Other places historically have been grocery stores. People go and they look and they say, well, Sauvignon Blanc, I've heard of that. That's $4. I'll buy that. Right? But when you go into restaurants now, I didn't put the slide in here. I pulled it out last night. But if you look at the growth in wine in restaurants, it's gone up by the glass phenomenally. And so now you go into a restaurant, and it's not uncommon to see kind of an average wine, for plus $10, $12, $15 sometimes for not great wines. And so, what are these new consumers, the younger consumers? What are they? By the way, younger, I'll show you later, means less than 65. I'll show you a slide in a minute. So, but let's think about new consumers. What do? They come in and they're going to compare spirits and they're going to compare wine, and you can get a really great craft cocktail. And if you're into getting a buzz, effective. So ethanol per dollar is more effective. And so we're struggling on this, what I call on-ramps for these young consumers. Let's see, table wine. Here's a good example of what I'm talking about here. So on the left side is everything under $11. That's this break right here. So that's down 12%. That's a huge amount. And this is through, I should have changed this. I didn't change the source down here. It's actually through March of 2022. So this is actually current. And you can see the higher end, the higher price you go, the higher growth there is. Those green dots. The other part is just share of the industry. So, obviously, if you're $50 and above, your share of the total pie is not that big by volume, right? This is where the biggest share is. It's $4.50 to $8, but it's declining by 12%. So that's a long-term problem that we have to fix. And if you've read the report or you saw anything, if you saw the State of the Industry video cast that I did earlier this year, I talked about something I'd been working on for the last 2 years with most of the larger wineries in the United States. We call it Wine Ramp, and you can still find it, wineramp.org. We had thought that we had raised close to $1 million to start a marketing program through the not the FDA, another government entity that I'm drawing a blank on. But what ended up happening was just we just put a letter out the other day, and I'll tell you guys, be a little more frank with it, is there were at least one, if not more, wineries that had sat on the sidelines and jumped into the debate. And this was a mandatory program where everybody would be assessed. To keep it fair, you have to have an assessment. So since it was the government, it's like a taxing authority, right? You got to pay it, and it was going to be on a volume basis. Well, we just can't have nice things as an industry, apparently, because I was amazed at the kind of consensus we had. The group that we put together, and again, it was most of the large producers, all agreed that there's a demand problem. And they all agreed that something needed to be done. And they all knew, at least they said they did, or we thought they said they did. But at the end, after we announced this in the State of the Industry report, it all kind of blew up. And they got together and said, no, we really didn't know it was mandatory assessment. It's not going to fly. So it was, 2 years of gratis work, down the drain. I was really hoping to do something nice that might help this side of the market. It's not our side of the market, but if this side of the market doesn't do well, eventually our side of the market's not going to do well. And I'll show you a couple of things. We'll get to those in a second. So here's one of the important things to grasp right now is that only 14% of people call themselves wine drinkers. They're exclusive wine drinkers. Most people drink all across categories now. And even I do. I mean, you guys probably do too. I mean, I'll drink a Truly, I'll drink a White Claw, I'll drink something else. Sparkling wine, by the way, and champagne is doing quite well. Prosecco, lower alcohol, it starts to fit health, the health things of other. And by the way, there's more pours in a champagne bottle for the little glasses than in a regular bottle of wine. So, I'm seeing more and more the health thing kind of matter. People are looking for things like calories. We don't put them on bottles. And so the marketing that we're doing in the wine industry has got to evolve. We can't market lifestyles that are rich and famous anymore. We've got to start hitting values that are more important to an oncoming consumer. And so this is where we are today. when I started drinking wine, I mean, really back in the 90s is when I started drinking wine more full time. It was the only thing that was good. Beer sucked, and spirits were a few years behind wine in premiumizing. And we've been premiumizing everything now. Beer, spirits, and craft cocktails, everything is good, and it's got demand. So we're having to share now more with other alcoholic categories. So this is a slide that I asked the Harris poll to run for me last year, and it was a simple I been to a couple of parties, socially distanced, and everything back then, and mostly young people. When I say young people, I'm sorry, I'm talking about under 40, and I'm looking at what's in these these stainless steel things, with ice in them, right? It's like horse buckets, and there's a couple of bottles of white wine, but there's craft beer. Next to it, there's somebody's going to bring a really nice bottle of Patron or something like that. This one was show off. Somebody else is going to bring a cheap bottle of something that just doesn't have the money or whatever. But that's when you're looking at what people are going to bring to the party, I always look, what are you bringing and what are you drinking? And at the end of the party, more times than not, I'm seeing the wine bottles that are, some of them aren't open, and some of them, the labels are just falling off, even if they are open, and they're not consumed. So this is the way I started to get at this demand question. and what you see is this is the 65 plus. And so 49% of my generation, the boomers, said that they would bring wine to a party first. And for my generation, that goes without saying. If you call somebody up and you say, hey, come to my house. Oh, can I bring anything? Oh, no. Okay, I'll bring a bottle of wine. That's the way the conversation would go. Well, if you go to 65 plus now, half of them said they'd bring wine because they were the ones that were in the 90s buying into this premiumization of wine before everything else premiumized. So, we developed these consumers really early and have carried them all along. And 64 and below, it falls off the cliff. So this is scary to me, which is why I was trying to do something in my copious free time to try to help the industry. And I don't think we're going to get there anymore. But what happens in 10 years? These 65 plus are going to be 75 plus, and there's going to be fewer of them. They're going to drink less. So this is what we have. It's I might have even been a little bit wrong in the way I've been characterizing it. I kept saying, well, we're not attracting young consumers. It's maybe not that. It's that the everybody else now puts wine in the same category with beer and everything else is really what's happening. And you had this one opportunity back in the 90s that's rolled through now all this period of time. And the boomers have been, pretty loyal to wine. So this is a headwind that's in front of us. I don't know how the industry is going to hold it, work on it. Obviously, we're just not going to work together. So I don't know how we're going to deal with it. It's a problem. When you look at Napa, this is what Napa looks like. Napa looks like pretty much everywhere else in terms of cohorts. This is year by year changes in cohorts drinking wine in Napa. This is mostly wine clubs. And you can see that for young consumers under 40, millennials, it's about 20% of the market. It's come up from 14, so there's a little bit of growth. I think the last 2 years have something to do with COVID a little bit, because again, my generation's probably staying home more, not going to wineries, not signing up for clubs. Some of them losing their jobs, some of them dropping out of clubs. So I think that has a little bit more to do with that. And you see the opposite side over here, right? So you see the drop from in the boomer side. So this is where, but still to this day, boomers are still marginally, let's call them in a tie, statistical tie with Gen X at this point. Gen X is a very small generation. So we don't see the kind of bandwidth, the kind of lift that we would get from the younger consumer. So one more time, we've just got to get these younger consumers in. There's a lot of things we can do, but it's going to have to take everybody's effort to make that work. And I think we'll find ways. We always have, but we always wait until we have to. And I think we're about at that spot. Sentiment index, something I started several years ago now, just to get an idea what people thought. So, and it's I use the Michigan Sentiment Index survey methodology, which is you say, as an example, does the economy positively impact me or negatively impact me or neutral? There's three, they only get three answers. And then you take out the neutral and you subtract positive from negative. So the if you look at this, 35% positive is really a pretty positive thing, because you got that middle ground. If you have 100 respondents, you're netting 35. So you can only get up to 100 here, and only down to 100, but it's really, really hard to get there with anything. If you're in the 50s, it's a pretty well regarded belief. So, the economy, we went from bad to, this is a Napa, bad to good. Just look through what people think. Economy's good, consumer demand good, sales channels rebounded. That's what happened in 2021. That's why it's so positive. It wasn't so positive before. Places where, and these numbers are a little bit different, but they're pretty similar across the board. So I'm just stuck with Napa. Labor is one of the biggest problems. People, surprised. Grape supply is a little bit of an issue. Fires, water, not having enough water means you don't have enough grapes. You don't get as many grapes when you have no soil moisture. And then other substitutes, beer, wine, beer, spirits, other things, cannabis, that doesn't help us. Whether it's actually making a negative thing for us, I don't know. But I think it's going to grow into a negative. Right now, I don't think it is, but I think it will grow into one. Water availability is biggest concern, and rightly so. This is, I don't know what we're going to do here. I think I have a couple other slides on them, so we'll look at those a little bit later. See where I am in terms of number. I'll just keep going because I don't have the other piece where I can tell what page I'm on. Bottle price by region, 5-year trend. Napa, $90, and you can see it's kind of cresting. A little bit of a downdraft now on price. 83, 94, 95, 91, 90. And I don't think that's a bad thing. I think more moderate pricing is better. There's something that I don't think I have a slide in, so I'll just mention it. Urban tasting rooms. Downtown Napa's got a ton of them. I'm not sure how many Yountville has. At first, the way we handled urban tasting rooms was a mistake. People would say, "Oh, I charge $45 at the winery. I'm charging $45 downtown." It's a different experience. But one of the things I've encouraged wineries to do is to make that downtown tasting room an on-ramp. Make it a place where people 40 and younger, don't play Frank Sinatra in there. Play, I don't know. I don't know the bands at Queens of the Stone Age, Eagles of Death Metal, whatever. Play, something that they're going to enjoy. And maybe have a happy hour at 3. Have more Sauvignon Blanc, something that's going to attract them. So you get your name in front of them. And I can't say whether the industry has fully adopted that. I know parts of it have, and it's working. And so now we're seeing actually some pretty good response, pretty good returns actually on urban tasting rooms. So that's working. Average tasting fee by region. I'm going to move a little faster. $60 in Napa County for the standard, 99 for reserve. It's a lot. Think about the reserve tasting. Let's call it $100. You got 4 people coming in, right? $400. How much is your really nice dinner going to cost? So it's it's limiting, and maybe there's a point to that. You are talking about wealth, and people will pay it for some of these things. So, but I mean, there is a limit. I don't know how much further we can go. This is the difference between by appointment and walk-in. Napa's always been the outlier. I went down to Santa Barbara once and I was speaking to their planning commission, and I had everybody come up to me and say, they're thinking about actually making by appointment tastings. So make sure you say that we don't want by appointment tastings. And I said, you guys are dumb. You want by appointment tastings. I'm not going to say that, by appointment. I mean, you actually get your customers' names. They sign up, they fill in the blanks. When they walk into your tasting room, they drink the wine, they leave. I mean, it helps you staff. You know exactly what your staffing levels are. So Napa's been an outlier for a long time. You can see we're down at the bottom. Here I'm pointing like you can see what I'm pointing at. But here, I'll point this way. This is the walk-in, right? So we're down at the bottom, 20% 2000, and we've only gotten fewer over the years. By appointment, all the way up into 64%. And both Napa, if you look at both, we're 29%. So there are still some, but it's regulatory obviously plays into that. But by appointment or both is obviously the way to go. The total walk-in is just dropping in, should drop in my opinion. Tasting room wine purchases, Napa's killing it, obviously. Looking at by region, you can see where Napa is still really good. Napa's the top of the pyramid. DTC cases sold dollars by region, and you can see once again that average DTC cases sold 16%, and DTC dollars 24%. This is from our survey that we just did. So at the top, Santa Barbara's doing pretty well, but Napa's right at the top too. Inventory shortage. A couple of bad years. I think we're a little bit light. And actually, if you look at what's happening in the bulk industry and the grape industry, that side of the business, the bulk wine prices for Cabernet have gone up. Napa Cab is hard to find. Good Napa Cab is hard to find. And so prices have gone up. They've pretty much recovered. That eventually drops back into real estate prices. So it means probably our real estate prices are somewhat sustainable for now in the Napa Valley. And in 60 years, we've never seen real estate prices from the standpoint of vineyards drop. Just in weird little regions, Pope Valley, weird parts of Carneros, like that, little drops in really bad markets like the Great Recession, just a little bit, and then they come right back and keep going up. So we've never seen Napa Valley real estate prices drop, and there's no reason to expect that would happen again. But this is where we are right now. We have a shortage. If growth rates keep coming down, as I expect, that may change. We may be more balanced, and that'll flatten out the pricing a little bit. We'll see. Percent of revenue from DTC sales. I don't know if I marked this. Yeah, I did. So Napa counties, you might be surprised to see them on the end or toward the, a little below average, but that's because we actually sell more through wholesale channels than most regions. We actually have demand that the wholesalers come to us and they say, can we have your wine, please? In some cases anyway. So that's why we don't have as much DTC revenue as you might suspect relative to the other regions. Sales growth projections. This is just for Napa. Again, you can see the smaller wineries have the biggest growth. Probably not surprised. The larger wineries have been around for longer. So you can't grow trees to the sky. And so the growth rates, but they're all very solid growth rates. And you can see across the board, it is lowercase, higher dollars. Let's see. What was I going to say about annual price changes here? Oh, I guess the prior one was this is over. It's kind of the same thing. Price increases. I forgot what I was going to say in this. So just ignore that one. one of these days I'll remember what I was going to say. Drought is a big deal. Not surprising to see Paso Robles up at the top of this. They've always had water problems. And so it's a major, but Napa is right underneath that. It is a big deal. You know, we have low soil moistures. It really impacts yields. It impacts a lot of things. Climate change is, you know, if I go back 15, 20 years and they started talking about it, I was going, yeah, I got to see some more science. I don't know. I don't think there's that many doubters left. You know, certainly in the Napa Valley, we've seen the impact of low soil temperatures, you know, increased, you know, bug pressure. You know, we have a new bug that just showed up, skeletonizer or something like that. You know, if you look at the trees, you know, have just dried up on the Pacific coast. And then they got beetles and then they died. So it's, you know, all of these things are related. You probably guys saw that, I shouldn't laugh, Lake Mead and Lake Powell are both at the lowest levels they've been since they were filled, which is Colorado River, which supplies Las Vegas, supplies Phoenix, and parts of Los Angeles, and almost all of San Diego. And you know, now it's so low that they're finding, you know, boats that sank who knows when. They found a guy that got stuffed in a barrel and dumped over the, you know, the dam or something. So that was the part I was giving. I don't think I should probably giggle about it, but it's, I mean, this is what they're finding as these water levels drop. And now we deal with water rights, and those water rights will back up through, even though they only serve those places that I just talked about. They don't serve them up here, but water kind of gets moved around in theory between water providers. So you know, it's a big deal. It's a big deal. When we said this again for Napa, drought impact on fruit sources, a large decrease in fruit sources, and we need to find new 24%. This is what they said last year, October last year. 53% said they were going to have a minimal decrease in fruit, but no need to find additional. So these guys felt okay. These guys didn't, is what it really gets down to. But it's impactful. There's no question about it. A couple other things: water availability. Napa responses: 41% concerned, but have enough water. 54% very concerned, and there's potential for serious water shortages. If you look at what people say they're going to do, it's mostly technology, you know, different kind of sensors for water use, in vine sensors, you know, mapping. There's a lot of technology that's coming around that, you know, can help. I think drip irrigation is pretty much installed in Napa, so that's not one of them. Find it. Some of them, people look for additional fruits. Some of them drill new wells. Truck in new water, boy, that's an expensive way to irrigate. So this is something that, you know, we'll hear more and more. I think it's going to dominate the news, if not this year, certainly next, if we don't really get a wet year. I think this is the last slide, and we can open for questions. But, you know, we always hear about, you know, companies changing hands. You know, Frank family's fairly good size winery changed hands. Treasury bought them here recently. There have been some others. Well, we just had Duckhorn go public. That's another one. So that kind of changed hands in a weird way. But if you know, you look at the people, where people think right now, 7% say that it's likely that they're going to want to sell in the Napa Valley within the next 5 years. So it's not a lot. Which means that probably you'll have a trickling of sales that'll continue. So more of the same from that standpoint. Okay, I'm done. At least I'm done with this, with that part of it. So if you guys have any questions, any comments, you know, if they're good ones, then bring them up. If they're bad ones, then keep to yourself. But yeah, let me have them if you got some.
There's one in the chat from Dave with Wine Direct. So does the club demographic look at brick and mortar wineries only, or does it also include the digital wine clubs, and it's specific to that 6% growth with millennials.
Yeah, it's a good question. It's brick and mortar.
Brick and mortar.
Yeah, and there's there's holes in the way that we analyze data right now. One of the biggest right now is these oh God, what do you call them? The private brands, right? Like Kirkland is an example. It's really hard to figure out what's going on with those private labels. It's not published anywhere, so actually trying to get that information is hard. And so there's a hole in how we analyze things, and I think actually that component of the market's doing pretty well. Dave's comment spot on. The companies that are start as sales are the dominant competitive issue in the wine industry. It's not winemaking, it's not anything, it's sales. How do you sell it? And some of these companies that are starting with as sales companies, you can go back to Naked Wine, started as a sales company. They have their own spin on things, but grown to be fairly substantial. There's a lot of other copycats out there of that. There's a bunch of them that are starting wine clubs. They're calling them clubs. Let us be your leader. And then there's always the one, well, if you like this, then you'll like this. Those clubs, which those things don't work, by the way. But the sales companies have actually done quite well. So we'll see more growth in that area too. Thanks for that question, Dave.
Any other questions? Feel free to raise your hand or unmute yourself. We have a couple more minutes. I know there was a lot of information there. It's always takes a minute to digest everything.
Or maybe I was boring.
No, you were not boring. I can tell you that right now. And we will send out this recording to everyone that registered. So that will go out probably tomorrow morning. So if you have other people on your team that you want to have watch this, please feel free to do that. Any last questions?
Any answers?
Any answers? There we go. Does anyone have a solution to any of the problems that are about to face us or are currently facing us?
Well, I actually have a question too. I mean, if somebody thinks there's something I missed in the analysis, that there's something that I'm looking at Napa Valley right now, and what I see is it's a pretty vibrant region. It's doing really quite well on the tourism side. And I think it's actually going to kind of hang in there for a while. I don't see a recession. There's a lot of talk about that right now. I think when I look at the 2s minus 10s, that's that signal to me that we've kind of hit the bottom, maybe in the stock market, and might actually rebound a little bit. And the Fed will continue to increase interest rates probably for the rest of the year. But I think we might get the soft landing we're looking for. So I'm looking at the Napa Valley as having a lot of opportunity. But if there's a category I've missed that I should have been talking about, I'm curious if somebody, has what that might be.
I think this was great, Rob, and thank you so much. I think one of the things that we get a lot of questions about here at the Welcome Center and through the chamber from visitors is about that experience component and how that winery experience and what that means has impacted the overall industry. Obviously, we've talked before, it's not about bellying up to the bar anymore. You're sitting down for a 90-minute tasting and maybe a bites component, but not necessarily a full food pairing and what that means. And I always think that's really interesting to hear kind of how that's evolved the industry and what that means for everybody.
Yeah, people that follow me, one of the things that I've been talking about for a long time is omni-channel. We can't just, and COVID proved it. We can't just have people come to the tasting rooms where we sign them up to get them in the wine club, and then we keep them for 30 months and then we do it again. That's not sustainable. If you think about who's coming to the Napa Valley, yeah, we have international. There's a lot more regional people that come here, but the tourist component of it is pretty good. But how many people are going to come from Minnesota and how often? You know, if you're a wine lover, you might come to Napa once. I mean, if you're a wine lover and a Napa wine lover, you might be here once in 3 years. Most people might be, you know, once in 7 or 10 years. So, you know, being able to have that experience out on the road, to me, that's what's, you know, really important. And we've kind of learned through Zoom that it's possible. We all have the backlash from Zoom right now, but corporate gifting is working very well for some wineries. They're continuing to work the Zoom channel for that. You know, I think that we have to do a lot more work in terms of, you know, regionally developing, let's call them, you know, Club Minnesota, Club Minneapolis or whatever, and have people that are willing to work that market and, you know, really drill down in specific markets, and then use, you know, a lot of the virtual things. But, you know, it's a different experience. It's a different way to do it. You know, we're not going to have 3-tier solve this for us. So, you know, marketing is going to be on us. And I think they're now with some of the electronic ways, technology, I think there's ways to do it. And I think we ought to try to do that versus, you know, being like birds with their mouth open. You know, the tourism in Napa Valley is great, but we can't go back to this single channel thought. It's just not the way to go. You're not going to find the kind of growth you want. Trees don't grow to the sky.
It's my new favorite phrase.
Yeah.
Well, thank you so much again. We really appreciate having you do this for us every year, and maybe we will talk to you about doing something in person next year, where we could all be together, which would be really great, because I know it's been a long time since we've had you up to Yountville, so we'd love to have you.
Be great. Okay, you guys have a great weekend.
All right. Thank you, everybody.